And good morning once again, options traders. Happy Monday to everyone. And we got a very cool and very interesting question from one of the traders in our group asking, can you create risk-free positions? And of course, he was talking about by using options. In other words, can we make them behave like a treasury bill or a treasury note? And the answer is yes. And if you know a little bit about options, you should be able to intuitively figure that out because options hedge risk. And so all we have to do is figure out how to eliminate the risk, and the rest will take care of itself. The market will price that at the risk-free rate. So there's a lot of ways to do it. I'm going to point out a couple that are very common, and I'll show you why they work, but I'm also going to show you why it's not a good idea to use. So let's go find out more about this really good question. Can you create risk-free positions? As always, before we do, please be sure to click like and subscribe. Greatly appreciated and helps so much to promote the channel. So let's start off with the first method that would be used, be a very common method, which would be a box position or a box spread. And so what you're going to do with a box position is a long bull spread and a long bear spread using the same strikes. And when you do this, this creates a guaranteed position equal to the difference in strikes. And of course, it's going to therefore behave like a T-bill. So this is a very common way that traders can use to create a risk-free position. Now, of course, just like T-bills, these will trade at a discounted price. So they're going to be priced at something less than the difference in strikes with these two spreads. And then they will mature or expire equal to the difference in strikes. And so that little difference between those prices is your risk-free profit. So here's what it looks like. Let's see what the long bull spread and long bear spread look like. So here's a T diagram that I've done many times in previous videos, but let's say that we have a long 100 call. So we go up under the plus sign right there, we have one long call, and then we're going to be short, let's say the 105. So the difference in strikes is 5, so we know it's going to mature or expire equal to the difference in strikes, or $5. So this is the long bull spread. Then we're going to pair it up with a long bear spread. So we need to be long the 105 put. So underneath the plus sign for the puts, we're going to be long 1, and then we're going to short the 100 put. So why does this hedge the risk? Well, as I've pointed out before, a really good visual whenever you're using T diagrams like this, if you have a wide distance or a long distance between any call and put at the same strike, think of that as a synthetic long position. And that's easy to remember because it's a long distance between them. So you can look at that and tell instantly that's a synthetic long call, short put, synthetic long position. It's going to behave just like long shares of stock. On the other hand, if we have a short distance between any pair of calls and puts at the same strike, then we have a synthetic short. And you can remember that because it's a short distance between these two. And so we could look at it synthetically and just say long put and a short call is a synthetic short stock position. So think about it. If you are long shares of stock at 100 and you are short shares of stock at 105, of course, you're not really long and short shares of stock. You're long and short them synthetically. But don't let that fool you. It's mathematically the same thing. That's why the synthetics will help you to understand relationships like this. So if we buy stock at 100 effectively and sell it at 105, that's a $5 profit. But it's guaranteed. No matter what happens, we own the lower strike call. We have the right to pay 100. And we own the higher strike put. We have the right to sell at 105. So no matter where the stock price closes, even below 100 or above 105, we can close this out for $5 guaranteed. And so it's going to behave just like a treasury bill. The market's going to adjust those prices so that it trades at a discount equal to the risk-free rate of the difference in these strikes. So now the reason it's called a box spread, if you look at this diagram right here, if you trace a line through those, kind of looks like a box. So I'm not kidding, that's where it comes from. but it's a box spread from the shape that you get on your broker's platform, and that's a very easy way to identify that you have a risk-free position. So the box spread, of course, will trade at a risk-free discount to the difference in strikes. So if the risk-free rate is 5%, and if we have the 100-105 box spread, we know, as we just found out, it has to be worth $5 at expiration, no matter where the stock is. So what's the price today? Well, to make the math easy, let's say it's a 1-year box spread, then we would just divide by 1 plus the interest rate. So if the interest rate is 5%, we divide the difference in strikes, $5, by 1.05, and that gives us $4.76. So you would have to pay $4.76 for this spread, and then you will collect 5 at expiration, which means that you earn a whopping 24-cent profit. And then, of course, 24 cents divided by your cost of $4.76 comes up to exactly 5%, as it should. So the first problem you can see with a box spread is that generally the profits are very low, basically because the interest rates are low, but you also have 4 positions. You've got the vertical spread with the calls and a vertical spread with the puts. You have 4 different strikes, and you've got 4 different commissions. And that right there is going to kill this 24-cent profit. So once again, it's one of these positions that are good in theory. They can help you to understand other types of strategies and options theory, but really from a practical standpoint, nothing you want to be putting on. So let's jump over to the tastytrade platform and take a look at a box spread. Okay, so now we're into the tastytrade platform. I'm going to use NVIDIA, but doesn't matter. Pick whatever stock you want. And we see that we closed a little over 183. So let's do the 185-190 box spread. Now you might be thinking, do we need to do a box spread where the stock price is between those strikes? And the answer is no, because that all comes out in the pricing. It all comes out in the wash. So as long as we have a $5 box, it's going to be priced at a discounted price to $5. So we saw that for the $5 box here, let's say that we buy the 185 call and we sell the 185 put. And then for the put spread, we would buy the, let's say, 190 put and sell the 190 call. And so there we have it. And if you look down here, it's telling you that the natural is $5.20. So you'd have to pay $5.20 plus commissions to collect 5 at expiration. Clearly a losing deal. Now, even if you go at the midpoint, $4.95, you're still going to be behind the risk-free rate. But if you look over here at the opposite, this just means the opposite side of the trade, or where the market makers would be trying to put this position on, buying at the bid and selling at the offer, they could do it at $4.70. So if you're paying $4.70 and collecting 5, that's over a 6% return. So clearly much higher than the current risk-free rate. So yes, that would be super beneficial if you're not paying commissions and you could put this thing on for $4.70. But what you're going to find, no matter which expiration or which stock, in almost all cases, you are going to be spending more than the difference in strikes, and that's not even counting commissions. So clearly, it's not going to work in practice, at least for retail traders. Okay, so that was a box spread. I said there were 2 positions that are very common. The second is a conversion. And a conversion is another type of what's called a locked trade, locked meaning that it really can't lose money. There's some little footnotes that go with that, but for the most part, we've hedged away all of the risk. And so if you are long 100 shares, let's say at $100, and you sell, let's say, the October 100 call, and then buy the October 100 put. So the options that you're using must have the same strike and the same expiration. And if we put these 3 positions on, stock, call, and put, we can see that we're dealing with a $100 strike, and that would be priced at the discounted rate relative to $100. So if we take $100 divided by 1 plus the risk-free rate, a 1-year conversion would be priced at $95.24. And then, of course, it's going to mature to 100, which means you're going to collect the 476 difference. And as before, if you take 476 divided by 95.24, you're going to come up with a 5% return. Now, interestingly, the strikes right here on our options do not need to match the current stock price. That's a myth. I've heard a lot of traders say that these would be very hard to put on because everything has to match. Not true. Remember, the markets will take care of that in the pricing. So while the call and the put have to have the same strike, those numbers do not have to be the same as the current stock price. So the strikes do not have to match the stock price. So if we have the stock at 100, you could do the 105 call and the 105 put, or the 200 call and the 200 put, and they will still end up with a locked trade. Now, the reason that this works is that if you look at this pair of the options right here, where we have a long put and a short call, that is a synthetic short stock position. And if you have a synthetic short stock matched with long stock, you're neutralized. So that's why it's eliminating the risk. So that's why even if, let's say, you do the 200 strikes, stock's at 100, but we use the 200 call and 200 put, you will double the profit in terms of the dollars, but it will be the same return just because they'll be priced at 5%. So let's go over to a pricing model on the web, one of my new favorites, and take a look at how the conversions will be priced and how they're going to work. All right, so this is a pricing model that I've been using recently. You can find it at option-price.com. And one of the things I really like about it, if you look at this tab up here, it says custom. So you can do things like implied volatilities, strategies, you can create your own matrix. Really a very cool pricing model. But let's put the stock at 100, days to expiration 365, again, just to make the math easy. Interest rates 5%, we'll keep dividends out of it. And down here, I'm going to enter different strategy legs. So you can see that I've got call, put, and stock. Those are the three pieces or the three ingredients that we need for a conversion. So I'm long stock. Now they make you say 1 unit, which really means 100 shares. And I'm also short the call and long the put. So if I'm long stock and I have a synthetic short stock position, these two, we should be neutralized. So I'm going to, for the first example, make the call and the put 100 because that matches the stock price. Remember, it does not have to, but for starters, we're going to do that. And if we choose calculate, there's our 476. Tells us the portfolio payoff. You can see it lining up just under 5. So that's going to be $4.76. But the thing to see is that this line is flat. Remember, these are stock prices here, so it's telling you that no matter where that stock is in 1 year, you have this $4.76 return. We've completely neutralized the risk. Now, as I mentioned in the presentation, we do not need the strikes to equal the current stock price because it will all come out in the pricing. So if we make this, let's say, the 105 call and the 105 put, we're going to see we'll get a little higher return because now we're discounting it from 105. And there you can see our line went a little bit above $5 right there. Now we can make it a little more exaggerated. Let's go to 200 and 200. Now we're going to double. We got 476 when we made it 100. We're now going to get twice 476 or $9.52. So it's going to look almost like 10. Watch this when we hit calculate. And there we go. So even though it looks like we're making more money, in percentage terms, they're the same. It's still going to be a 5% risk-free return. But the thing to see is that that line is perfectly flat. You have absolutely neutralized the risk. So it's just showing that, yes, there are lots of ways we can neutralize the risk, but you're just going to get the risk-free rate and you're going to be paying commissions to do so. Now, just for one more for fun here, let's go back and do one of the box spreads. Let's see if we can, let's do a long call and a short put. There's our synthetic long, let's say at 100. And then we did a call and a put synthetic short we did at 105 in the presentation. So let's do this at 105. And we were long the put and short the call. And now we know that this is going to be priced at 476, so we should see about a 24-cent return. So if everything goes right, let's check it out. And there we go, lining up just underneath 25 cents. And again, a flat line. So there's your box spread. So yes, there are lots of ways. We just looked at two of them, the conversion and the box spread. But the thing to see is that the commissions are going to eat you alive. So I hope that answers your question that yes, there are ways to do it. It's nothing you would ever want to do as a retail trader, possibly legging in over time if you had some really big positions and wanted to neutralize them. But to try to just avoid risk in the markets and make money, absolutely not worth doing. But don't let that stop you from learning about conversions and box spreads, because the knowledge and the understanding of the options theory behind this will absolutely help you for strategies that do count. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.